I have a few longer series and videos being worked on, but figure for times during gaps or around holidays, a worthwhile series of smaller videos could be knowledge known within the financial system, but not very public. Some things much more secret than others. Some things people don't like to look at. So for the first episode of the series, here are 10 secrets of Wall Street. REIT wash trading. Here I'm using the term wash trading rather loosely. Within financial markets, wash trading is an illegal form of manipulation, where the same entity will trade a security between different accounts, or even within one account, buying and selling the same security over and over to create a false picture of volume. Within REITs, something similar happens, and happens alarmingly often. By now, everyone will have heard of large REITs buying up residential houses. This has drawn substantial outrage, as people see large financial companies making large cash purchases of single-family homes, further putting strain on the housing supply. And while the argument that some being available for rent is useful does have some merit, what is actually happening within this market is far from how it presents itself, and has become very destructive. Real estate values often depend on appraisals or sales observed by the same property in the past, or similar in the present. Now imagine if you are a REIT, and you would like the value of your property to increase. If you are a financial company which holds different funds, then selling one property to another makes it appear as though there is greater demand for the property. Increasingly, more real estate investment companies have been observed forming more and more arcane layers of shell and subsidiary companies, REITs trading properties to each other, often within the same company, moving from one portfolio to another, or in an area with infrequent transactions, real estate companies intentionally overpaying, thus being able to generate a false picture of the value of other properties. This in turn inflates property values, not only for those specific homes, but many in the surrounding area. Window dressing. This has become such a well-known phenomenon that it's a commonly known term within financial markets, yet it's something that not all retail investors may know, and it's very worthwhile to understand. Say you are a fund with a particular investment policy. You have a mandate to invest a certain way, yet over the course of the quarter, you start making some moves that push you a bit off track. Perhaps you made a very heavy bet into one security, and you know that your clients wouldn't be particularly happy with that. Or you started buying up shares of an index fund, which would look lazy and inactive to your clients. Well, right before the end of your reporting period, you might shift your positions, so that on the date in which you record your holdings, it appears as though your investment strategy was entirely different. Thus, when somebody looks at your quarterly holdings, it will appear as though you were making better decisions, more in line with what your clients expect. Today, many retail investors use ETFs, and this does address that issue, at least in great part, as they report their holdings daily. Yet, there still remain many funds which are quarterly reporting only, and it's worth checking their holdings against their actual performance, because they might just be putting up holdings for show at the end of the quarter, dressing the windows. Commodity manipulation. This is a very old one, and one which has had outsized geopolitical significance for centuries. Think yourself to be one of the great European empires of old, and you have built your economy around your home nation being a manufacturing hub and your colonies producing cheap commodities. Or imagine that you are one of these nations in the 20th century. Your territorial empire has fallen, yet you wish to retain the economic benefits, keeping those former colonies as cheap commodity producers. One thing that you would not want would be for those countries to get rich producing cheap commodities, allowing them to transform into high value-add manufacturing nations. Well, the countries that had control over the financial networks of the world, those with the large banks and who ran the exchanges, found that with control over the money supply, they could use futures to push down commodity prices. Imagine something like gold or copper. If the success of your financial system and your business endeavors rely on those commodities being cheap, then via your bank, you could use credit creation to enter into levered futures positions. manipulating the market. And as the futures curve shifts downward, so too will the overall market, artificially depressing prices. This has caused substantial ire from commodity-producing nations, and today we see a substantial move across the world to take commodity pricing power away from these nations. Countries like Russia, China, as well as some in Africa and South America, seeking to have a natural commodities market, taking pricing control away from the financial hubs of London, New York, and Paris. Yield control. We've been seeing a lot more of this recently. The modern system is heavily dependent on the market for sovereign debt. The ability for governments to pay for anything has become entirely intertwined with their bond issues, and thus it is of great importance that the interest rates of these bonds remain at a level tolerable to the governments. Thus we have increasingly seen central banks and treasuries acting to manipulate the yield curve, the overall level of interest rates at different maturities, as well as the slope and shape of each different rate at different times to maturity. You may see governments and central banks engaged in attempting to keep yields low. For example, many drastic actions to protect the German Bund. Yet another quite interesting one is nations around the world attempting to influence US Treasury bonds, since the global currency largely is the US dollar, with so much of the world's credit supply being created in euro-dollar credit markets. It is very necessary for governments to maintain a good relationship between their bonds and US Treasuries. During the period from around 2022 to 2024, as the Federal Reserve was raising interest rates rapidly, we began to see the European Central Bank buying and selling not only German bunds, but US Treasuries in enormous quantity, all the while working closely with Janet Yellen, the Treasury Secretary at the time, ultimately inducing a yield curve inversion, maintaining appropriate spreads, thus protecting European governments and banks at the expense of the US. Things have gotten so extreme in Europe in particular that constant yield control is being done by the European Central Bank, with the European Central Bank even introducing an entirely new financial instrument, the Transmission Protection Instrument, specifically for the purpose of maintaining control over the yield curve. One big problem with this is because of just how manipulated yields have become. It has become increasingly difficult to get a real sense of credit. For example, the very low yield on German bunds, a product of the German government forcing people to buy it, the European Central Bank engaged in buying and selling, manipulating the price, and the actions of the Yellen Treasury. With yield curves across the West so heavily manipulated, there is one big outstanding question: how long can this last? Credit creation. This is something that in broad strokes is by no means a secret. Just about every modern economic theory has a model of the creation of money, generally based around base money being created by the central banks, and the money supply growing via banks. An archetypal form of this model is a central bank creates the base money supply. Then using the base money supply, banks create more money by lending out excess reserves, whereby the lower the reserve requirement, the larger the money supply will be. This, however, is very simplistic and does not match modern money. The issue here is that the general model of how money is actually created is commonly understood, but people don't really like to talk about the scale at which money creation actually occurs, or where it happens. Following the Second World War, and particularly exploding in the 1970s, a vast amount of the creation of US dollars began to occur offshore. Banks not bound by the reserve requirements of the US, rapidly expanding the money supply, as new money is created when banks make loans. Imagine there is a bank offshore with $1 million. You would like a loan. You go to the bank and take out a $1,000 loan. You put no money in, and they take no money out. They have simply written you a loan. Thus, the money supply has grown by $1,000. Within the United States, this is bounded by the reserve requirements. Say, a bank can lend out no more than 90% of their reserves. Yet offshore, this is not the case. In many cases, banks can do this functionally infinitely, meaning that there is no constraint on the money supply. A bank in London, having woefully inadequate reserves, making loan after loan after loan in US dollars. The financial firms receiving those loans, going out and buying securities and financial contracts, using those to get more and more loans. Thus, we have found ourselves in a position where a vast swath of the US dollars in existence have simply been created by foreign banks, not constrained by the regulations of the United States, and very detached from the actual supply of US treasuries that they have. This has led to quite a fight in financial markets, with the United States beginning to resist this, having made sizable moves in the past few years to cleave the domestic dollar off from this foreign dollar. Yet the offshore dollar credit markets still exist, and it certainly bears little resemblance to the simplistic, the Fed creates money, multiply that by 1 over the reserve requirement, and you get the money supply. The models just don't match the reality. Foreign banks make the money. Oh, just one tiny little thing? Yeah, the reserve requirement in the US dropped to 0 in 2020. Yet there still are capital requirements within US banking. Requirements that are still vastly more reasonable than those in foreign banks. Private equity valuation. How do you value a unique private company, particularly if there are no other companies like it? The main ways that private equity firms value their holdings are through traditional discounted cash flow, projecting out future cash flows and discounting them to the present. Comparable transactions within private markets, observing private transactions that have occurred with similar companies, or public market comparables, looking to public equity markets and trying to find some reasonable approximation, making some adjustments, including an illiquidity adjustment. Yet all of these give the fund a lot of wiggle room. Discounted cash flows, particularly for a private company growing quickly, you could say it'll grow at 20% or 23%, and that's a radically different value. Nobody has any way to know if your projections are real. Comparables. How can you tell what a comparable is? Every company is unique. There's a lot of wiggly room you have there. Say you find something that is rather similar. You have a lot of little adjustments that you can tweak. People have seen phenomenal performance out of private equity funds, yet the performance numbers are up to the discretion of the fund. Now, they will argue that there are industry standards. Yes, but if this is an industry-wide problem, then standards mean very little, as every fund is incentivized to get the best valuation they can. And ultimately, they're unprovable. You can only really tell a value once it hits markets. And increasingly, as IPOs have become less and less frequent, we have seen private equity funds selling to themselves. Say, private equity company Fund 7 selling a company to private equity Fund 8, just holding the same thing and saying it's worth more. Or private equity companies selling to each other, both with the same incentives. Now, there are certainly companies that are doing very good business, but beginning in the 1980s, this has become a place to be to make money, as private equity funds can charge enormous fees. And deep down, I think everyone knows that there's probably some wiggliness going on, even in companies you might believe in. When you're paying somebody to grow the value of something, and he tells you what the value of it is, just be extra weary. Laundering. Governments and the banking system have made a grand show of anti-money laundering policies and laws, yet the true scale of money laundering and the frequency at which it is allowed to pass through undisturbed is quite astonishing. Here are just a few major examples. From 2018 to 2022, Deutsche Bank in Estonia was found to have been facilitating 230 billion euros in criminal money laundering from post-Soviet nations. In 2012, HSBC was found to have failed anti-money laundering policies, facilitating over 881 million in cartel money. In 2010, Wachovia was found to have facilitated over $380 million in cartel money via FX markets, found not to have been monitoring those transactions. In 2014, BNP Paribas pled guilty to sanctions evasions, routing billions through the US financial system for Sudanese, Iranian, and Cuban entities. In 2020, Goldman Sachs was involved in billions misappropriated from the Malaysian State Fund. In 2024, TD was hit with over $3 billion in US fines for long-standing compliance failures facilitating funds from drug and other illegal markets. In 2021, NatWest was prosecuted in the United Kingdom for money laundering failures related to a customer who deposited £264 million in cash. It was found that employees repeatedly reported suspicious activity, yet the bank did nothing. And this is only a slice of the big ones that were found. There is an enormous offshore web, stretching across locations like the Cayman Islands, Bahamas, Bermuda, Hong Kong, Singapore, London, Luxembourg, Geneva, and touching every continent on Earth. Well, I don't know about Antarctica, but probably also Antarctica somehow. Money laundering is enormous, and for the past century, it's been integral to much of the banking system. Vast fortunes move around the world every year, from all sorts of criminal endeavors. That is not all under a mattress, nor is it in Bitcoin. It's in banks. And with the scale being what it is, with so many examples of banks appearing to not even care to stop it, and the very long history of some major financiers being tightly intertwined with criminal syndicates, this is a much more alarming situation than is broadly heard about. LIBOR manipulation. This became quite a scandal a while back, particularly following the 2008 financial crisis. For decades, beginning to emerge in the 1960s and becoming widespread in the 70s, the offshore market for dollars began being priced in LIBOR, the London Interbank Offered Rate. The issue was that as the market for US dollars was growing overseas, the banks in London found that they needed some benchmark to peg US dollar credit to. Thus, the London banks involved in US dollar credit came together to form the LIBOR benchmark. Every day, a group of London bankers would meet and discuss what they had priced dollars at the day prior, creating a benchmark rate, so that each day there would be a visible number, the price of dollar credit. Over time, as this grew, it would become the most important number in the financial system of the world. By the 1980s, LIBOR was the dollar price, not only overseas but in the United States. Yet this presented a problem, for US dollar credit globally was being priced by a benchmark set by London bankers. They could, in theory, make it whatever they wanted. And in 2008, this became very evident, as it was found that the LIBOR committee was putting out numbers that were a bit too detached from the actual market reality. And when it comes to short-term credit, even very small changes, as low as a couple of basis points, can make an enormous difference. But worse than that, because this became the global pricing mechanism for US dollars, it became such that the financing needs of the offshore dollar market began to supersede the economic reality of the United States. Say the Fed were to raise interest rates by 1%. Because the offshore dollar market was more highly levered with less sufficient reserves, the strain would hit the offshore dollar markets much more sharply than it would domestic. Yet as domestic banks were pricing their credit in terms of LIBOR, as strain would push up LIBOR in the London banking system, it would then push up rates in the US, turning a 1% increase by the Fed into 2, 3, 4, maybe even more of an increase in actual US dollar credit. And particularly as instances were found of the LIBOR committee just making up what they wanted to see, it became evident that the US could no longer live like this. And thus, in recent years, LIBOR has been phased out in the United States, being replaced by SOFR, the Secured Overnight Financing Rate, a rate based on actual credit transactions in the US from loans collateralized by US Treasuries, making rates in the United States no longer based on whatever London bankers say it is, and instead actual observed market transactions domestically. Closet indexing. This is related to the window dressing issue from before. An alarmingly common behavior amongst fund managers is to put a large amount of one's fund into an index, thereby going along with the market and not taking risks. It's like the phrase, "no one ever got fired buying IBM. If everyone goes down and you go down, then you don't look that bad." But what's really risky is if the market goes up, and because you made a unique decision you go down, your clients might think that you don't know what you're doing. Thus, the safest thing that one could possibly do is to simply track the index. Yet if you are an active manager paid to actively manage, you can't just buy an index. But perhaps you put a large chunk in the index and be a bit more risk-off with the rest. Or maybe you're mostly in the index, but at the end of the quarter you start buying more things, doing that window dressing. There are different ways to go about this, and it's certainly been something observed frequently, though over time has become much more scrutinized, and in recent years it has become much more difficult to get away with. Ultimately, it comes down to simple psychology. Many managers are just much more afraid of being wrong than excited by the possibility of being right. And last, the models don't work. It's not that all models everywhere are broken, but people have been led to believe that financial firms have developed extremely sophisticated models to manage their risk. There's this narrative that we have engineered away crisis, and that is simply not true. Prior to the 2008 crisis, value-at-risk models were commonplace and were widely accepted as the risk management standard. Yet these models did a terrible job at truly modeling tail risk. They were right almost all of the time, but once one goes out a few standard deviations, the models simply do not capture the reality. Thus, banks were led to believe that they were in much safer positions than they really were, as the probability distribution of events that they were looking at did not encompass what actually happened. Now, there's no way to model everything that could happen, but generally there is a realization that many of the models that there is enormous reliance on are simplistic and don't handle outliers very well. There are different issues with different models, but the main problem is that we don't have a very good way of dealing with extreme events. And not only that, but the probability of extreme events is generally underappreciated. There is likely far more risk in the financial system than is being accounted for. Pricing models that are not quite right, risk models that don't capture tail risk, and chains of events that models simply ignore. Thus, it is incumbent upon us to recognize the limitations of models. They can be very good approximations, but you shouldn't blindly rely on them. Well, I hope that this one was fun. I have a larger film tearing into our economics about to come out, as well as a series on finance and religion, so do subscribe if you're interested in seeing more, as well as market and event analyses. Until then, have a splendiferous night.